Hello and welcome to our real-time daily trading ideas webinar presented here from Admiral Markets. We say welcome here to all traders around the globe. We have here 5 days with 5 different traders, so with 5 different trading styles. Today we have the pleasure here with Medrow. He is one of the famous Forex traders here in the German area, or more the international area, because he works in a lot of international banks in his lifetime. But later more about Jay and his trading ideas. First of all, we need to show here this disclaimer. So please be aware that all we are showing and presenting here is just in our personal opinion of our traders and not an advice for investing. And here we have a quick overview of the ESMA regulations. These are started in August last year. So we have leverage only for retail clients here, and as an example here for the DAX 30 with 1 to 20, or for the major forex pair here, Euro USD dollar, from only 1 to 30. But here you have a quick overview of your options. Maybe you are able to enter the professional client status. For more information about this, you can contact our customer service. Yes, here you have a picture for me. My name is Tim Tam. I'm an account manager from Berlin here in Germany. We have the pleasure here, as I already said at the beginning, with Jay Medrow. Here you can see all the pictures from our traders here in our international webinar. So also we have here a quick overview of some of our offerings, and maybe here, for example, our bestseller, the DAX 30, we offer it with a typical fixed spread of only 0.8 point during the main trading hours. The most of our products are without any commissions, so they are very low at all cost sides. On the right side, you can see some of our awards here. Now we have a new one from the DKI. It's called Deutsches Kundeninstitut. It's one of the famous research institutes here in Germany. So we are proud to get this award for a couple of weeks. Yes, One World Global Office. So we are an international broker. So we have a lot of products licensed all over the world. So what does it mean in the single case? You can also contact our customer service for more details and information. So now I'm quiet. That's it for me, from my side. I say good morning to you, Jay. I'm looking forward to what you are showing here for the new week. You have the screen and the stage is yours.
Good morning, my friend. Good morning to Berlin. Good morning, traders. Great to be back. We got a new computer system, so I just got to figure out real quick if you can see my screen. Please let me know if you can see the screen. Tim, can you?
Yes, all looks fine, Jay.
Okay, excellent. Awesome. All right, guys, we had such an exciting week last week. I hope you guys managed to make some money. And this week, economic data is a little bit less of importance, but let's dig in. I have to move my head to the left because unfortunately the new system isn't set up quite right yet. But I hope you can hear me okay. So last week, I was keen to short the euro versus the pound. Now there's one factor that I missed, and that is that at the end of each month, as long as the UK is still a member of the EU, you have to pay, so to speak, your club membership fees. All right, excuse my punt. And what happens is that the central banks of both countries need to intervene in the market to do exactly that. So what happens is that we usually have a short bias into the month end of the pound versus a long bias into the month end of the euro. I felt that the pound and the Brexit scenario would develop towards an Article 50 extension. We had 7 different votes in the UK in the parliament. 5 of them got dismissed and 2 of them got accepted. And at the end of the day, the situation was such that the pound actually saw weakness, not strength, because the Article 50 extension was moved out of the picture. It's not happening. So now May needs to go back and discuss a different scenario with the EU regarding the Irish backstop. And the EU says, come hell or high water, no chance in hell that we're going to discuss that. So that introduces uncertainty into the market, and that's why we saw pound weakness and not strength. Nevertheless, the trade is still open, and you can see the arrows, and there I pointed towards some institutional flows. So we saw some longs, and now we're seeing the first short distribution. The pound, nevertheless, weak this morning again. So I'm keen to see how this trade is going to develop and turn out. But it's still open at the moment. The other trade that we alluded to last week was long the gold market. And the first arrow right here is the first buy, institutional buy, then a reaccumulation, another reaccumulation. And now we saw a distribution. If I look at the market this morning, we see a very strong dollar. The dollar index is rallying. So one of my traders, Jörg's in the room. I hope you're not long gold at the moment. Look for lower prices in case you want to get back into the long. But that long play is over for now, okay? Headlines this morning, what do we have? We have a slightly risk-on picture coming out of Asia. Asian equities were slightly positive, but we do have the Chinese Lunar New Year holiday in the market. So we have mass closures over there currently. And we can also see that in the CNH market and the Chinese yield market. Yields are coming off. We also saw that the Sydney market was up by 50 basis points, Nikkei by 40. Why? Because we had a weak yen. And then we also had some interesting developments in the equity market where Sony reduced the revenue outlook. They only sold 8.1 million PlayStation 4s versus 9 million last time. So they're reducing their outlook. Honda was down 34% on their 9-month net. And Panasonic, after the market closed, cut their guidance. So that is the issue that we're seeing globally, guys, for all the equity traders and investors in this room. What we're seeing is that earnings are coming down. Earnings expectations are coming down. So the name of our game in this business is rate of change. It's always dependent on how fast something is growing or how fast something is contracting. So the rate of change of whatever we're looking at, and in Forex, obviously, it's economic growth and inflation, is the name of the game. Shanghai was closed, and the Hang Seng, due to the nature of Shanghai being closed, was unchanged. Overnight, we also had PMI data. And again, this is by far one of the most important indicators we're looking at. And we had Chinese Caixin services coming in a little bit better than expected, but the quality of the data wasn't that great. So you need to have a caveat there. It's not that good as the headline number may suggest. And we had composite PMI at 50.9. Again, PMI, the magic number is 50 or slightly below that, which would then indicate a contraction of the economy in question. The PMIs itself is about 80% correlated to the equity index of the respective country that we're looking at. While I'm speaking to you, I'm having a look at the oil market. Dollar index is still high. I'm going to short the hell out of 55.66. Sorry for that, guys. Just got to do that real quick. All right. What else do we have? We have Bank of Italy Governor Visco. He sees downside risk for Italy's growth. He doesn't really think that they're going to hit the 1% GDP growth. Okay, we're short gold. That's good. Short oil. Sorry for that. Just real quick. 51.63 is 12 is 75. Okay, we're good. Now let's have the dollar grow, otherwise rise. Otherwise, my gold, my trade is wrong. Anyhow, sees downside risk for Italy's growth and interest rates on government bonds. Who is the largest holder of Italian government bonds? The banks. Are the banks in possession of really, really good loan books? No, most of the banks aren't. So we got to be mindful of that we have a situation in Italy where rising yields will cause, we're getting stopped out here, very strong oil market. Okay, doesn't matter. Rising yields will actually cause falling treasury prices. And falling treasury prices in turn mean that we have losses in the Italian bank books, and that, my friends, will be a problem for the refinancing of Italian banks and the government in and of itself. So the Italian story is alive and kicking and well. We need to be aware of that. Okay, Aussie dollar pressured overnight. building approvals came in dismal. It was the worst contraction in 5 years. It was just horrific, really, really bad, unfortunately. 1 month CNH HIBOR, Hong Kong Interbank Offered Rate, dropped to a lowest level since 2016. Why? Because it's illiquid right now. It's an illiquid market. They're on holiday, so that makes sense. Euro, there is the market currently pricing in a probability that the next rate hike by the ECB is not September 19, as we alluded to many times during our morning meetings, but has now moved out to June 2020. So we need to be aware of that, okay? What I have here is the front month soybean contract. Why are we looking at soybeans? Anyone have any idea why we're looking at beans? My traders should be aware. Trade war, correct. It's a leading indicator for the trade war for us, in a sense. So this market has been rallying, and as we can see now, we're seeing some institutional sellers stepping in. So that's something that we need to be aware of, because that's a leading indicator in terms of how well going. Okay, the bean market is saying not so fast, might not be as great as the tweets from Mr. Trump are suggesting. Okay, on we go, onwards and upwards. Overnight picture, we saw some strength in the dollar, and that, let me look over, continues. Yeah, I'm long dollar yen. I expect it to hit into the 110. And we saw some weakness in the yen, and then obviously some weakness in the Aussie dollar, naturally so. And then, let's see if I can get that picture moved into, I hope Tim apologized for the advertisements to the right and to the left, but I just wanted to show the guys and gals the numbers from overnight. So we're seeing building approvals in Australia coming in horribly. Then we had ANZ job advertisement, also a contraction. We had Spanish unemployment coming in worse. We have Centix investor confidence coming in worse. We had pound construction PMI coming in worse. We have PPI coming in worse in the euro area. And then we have later on today, retail sales, no, that's actually tomorrow morning, retail sales in Australia also expect to be coming in worse. So it's really difficult to find a positive currency right now to long the dollar moment, but that can change anytime. All right, here we go again. Where is the PowerPoint presentation? Here we go. Okay, so I just wanted to show you that real quick. Thanks for your patience, and I need to get accustomed to the new system, so sorry for that, guys. All right, what do we have got going on? Talking about the dollar, we had ISM manufacturing last week coming in at 56.6 versus 54.1, but the export orders were 27 months low due to the trade war. So both sides are hurting based on the trade war, China and the US. We had a stellar non-farm payroll number on Friday. It was brilliant on the headline side, came in at 304,000 new jobs versus 165 expected. And it was the second month in a row that we came in over 300K. So the government shutdown is not impacting anyone. Thanks to Chris, one of our traders, who presented really well on that scenario, that the government shutdown has not that big of an impact as we thought initially. Average hourly earnings, though, came in lower than expected. And again, hourly earnings is, to us, it's important because it's an inflation gauge, and inflation is the name that we're playing of the game here. So if that comes in lower, the Fed has less incentive to switch. Speaking of the Fed, they announced on Wednesday that they switched from hawkish to neutral, and they're now data dependent. So the Dixie is ranging, that's the dollar index, between 96 and 95. Sorry for that. That's the squawk in the back. Don't know how to close that down right now. Jay Powell also alluded to the head of the Fed that they would be expecting their balance sheet that we all we're working with the assumption that they're actually reducing the size of the balance sheet, and now the Fed is communicating to us that they think it could actually end up being larger than the Fed, thought it to be last year, and that they're flexible in reducing it, i.e. they're flexible on quantitative tightening, and they kept stressing how patient they can be now with the monetary policy. So completely a complete switch from hawkish to neutral now. That's important because any other central bank in the world now can also switch to data dependent. Market is currently pricing an 11% probability for one rate cut by the end of this year. One rate cut. So I recall our traders laughing because about, I don't know, a few weeks ago only, Goldman published this research piece where they were talking about 4 rate hikes. Well, that's not going to happen right now, Mr. and Mrs. Goldman, because the market is not agreeing with your research piece. We have the State of the Union address on Tuesday by Trump, and he wants to discuss coming up with a national emergency so that he can have his border wall funding. He would like to have Congress pass his NAFTA replacement deal. I think some of you or some of the traders out there are not aware that the NAFTA replacement deal has not been passed by Congress yet. So it's not even in effect. He's also going to ask Congress for an infrastructure bill, naturally so, because the Republicans only have the Congress now, the Senate now, but the Democrats are holding the Congress. So there's not going to be a tax deal 2.0, unfortunately, not really happening. And hence, he's going to ask for an infrastructure bill to push the U.S. economy upwards when we're looking at the business cycle, because we're towards the end of the business cycle in the U.S. And he's going to update Congress on the China trade talks. I tell you what, I'm super eager to listen to this tomorrow. This guy never ceases to amaze me. It's just amazing to me. All right, then we have on the pound side, Brexit, Bank of England. We had last week Parliament passing the Brady bill. That's the backstop that needs to be renegotiated now, and the Spellman Amendment. And the extension of Article 50 was rejected. Hence, we saw pound weakness due to increased uncertainty. This morning, negative numbers, so pound weakness, especially given the dollar strength. Then EU is unwilling to renegotiate the backstop if the UK would consider a permanent customs union, then they would offer to potentially renegotiate. Then we have following deadlines. On Feb 14, we have the meaningful vote. And recall last time May lost by a margin of 230 votes. And of those 230, 118 were of her own party. And then we have March 29, which is the Brexit deadline. There is a prospect of no deal Brexit, and that has increased significantly now due to the uncertainty. Thursday, we have the Bank of England rate decision, and they are expected to leave rates unchanged with a 9-0 vote. But what did the data tell us in between? Well, unemployment rate is at 4%, so that's full employment, and average weekly earnings are at cycle highs. So one would think, hey, under normal circumstances, we were talking and thinking about a rate hike right now and a lot of pound strength. That's correct. But given the Brexit situation, we're not. Then in November, we had GDP coming in at 30 basis point growth, and that's a slowdown versus the 60 basis points growth that we saw in December. Nevertheless, since the beginning of the year, the UK economy has been growing, okay? And then we have headline CPI printing at 2.1 versus 2.3, and that is due to the decline in gasoline prices. Inflation could move lower near term due to oil and upward in the medium term due to domestic cost pressures, i.e. wages. So that's what we keep an eye on for the pound. Fortunately, the Bank of England already told us we can't really do anything because of the Brexit uncertainty. Then we have Aussie dollar. Tuesday, we have the rate statement. Here as well, the market is expecting an unchanged vote. But last time, the RBA talked about their next move going to be a hike. Okay, that's interesting because since then, we had a slowdown in GDP growth. from 90 basis points down to 30 basis points. And we also had inflation coming in at 1.8%, which is below the CPI target. So interesting, right? We have declining house prices, which are also likely to weigh on consumer spending. Housing is one of the markets that the RBA is keeping a keen eye on. So if that deteriorates, you will see the Aussie dollar weaken. Some analysts are expecting the RBA to reduce their GDP growth forecast, but retain a positive medium-term outlook. And then especially the market is expecting the RBA to reiterate their phrase, the next move will likely be up, but is still some way off. If they keep those words out, please guys, expect weakness in the Aussie dollar. Focus will be if the RBA has also shifted to neutral, like the Fed, due to a global slowdown. And there's no question about it that we have a global slowdown currently. We have worsening domestic readings. We have an economic slowdown in China, and Aussie is a suburb of China. We have a dovish FOMC, and we have all four large Aussie banks hiking variable mortgage rates. And that hiking of variable mortgage rates is taking pressure away from the RBA to act. Yeah. And then we have the overnight index swap market pricing in a 30% probability for a rate cut by November 19. A rate cut. So we have the swap market indicating to us a rate cut in the US by year end and a rate cut by November of 2019 in Australia. Markets are trading at an 80% probability of a rate cut to 1.25 by the second half of 2020. So an additional rate cut in the year after that. If you're still buying equities, be careful. Add some shorts to your portfolio, please. This is going to be violent. Lots of volatility. We are end of cycle, and we have a global slowdown in growth. Okay, look at the numbers, look at the data. Do not get sucked into by positive headlines or tweets by Trump or anything like that. The data tells you the reality of where we are in the business cycle, and the business cycle is king. It tells us what to invest in and what to do. It's crucial that we keep that on the radar, crucial. Some of our analysts are expecting the RBA to trim rates by 25 basis points by the end of this year, and an additional cut with the magnitude, same magnitude, 25 basis points in the first half of 2020. So similar to what the market, the swaps market is pricing in, okay? Last but not least, we have Canada on the docket for this week. On Friday, employment change expected 8,000 new jobs. Again, I keep stressing this point. We always need to look at the quality of the data. Are these jobs that are getting added, are they full-time or part-time? Part-time jobs are of less quality than full-time jobs. So 8,000 versus 9,300 last month, and the unemployment rate is expected to tick up to 5.7, meaning that's already priced in. Do not hit the sell button when you see, whoa, it's coming in worse than expected. No, it is 5.7. That is what expected. It needs to come in much, much worse for the Canadian dollar to sell off, and we have a high correlation to the oil market at the moment. So the focus of the market will be on wage growth. The Bank of Canada is using something that's called a wage common measure, and that fell throughout 2018 due to the oil price decline. It's currently at 2.3% end of last quarter. So that's what we have an eye on. The Bank of Canada also recently noted that there's high involuntary part-time employment, structural factors contributing to slower wage growth. No wage growth, no pressure to hike rates. Very simple. Very simple. So we all need to watch the oil market. We need to watch US dollar, and then both factors will contribute to Canadian dollar either strength or weakness. It's a good market to play at the moment, but we need to be keenly aware of what oil is doing and what the dollar is doing. Okay. Trade this morning. What do you think, guys? What could we trade this morning? What do you have? If anyone has anything. Hendrik, I know you got something. Aussie short, I like it. S&P long, possible. CAT long, New Zealand long, yeah. Short Euro New Zealand, I like it. CAT versus Swissy, Mick, interesting. Long or short, Mick? Long or short? Yen short, like it. Oil short, Chris? dangerous. We do see some. Let me check. I agree with you right now. Yeah. Alex, New Zealand Swiss long. Correct. Oil short, Christian. That's interesting. Oil short. Yeah. 55.35 is the POC right now, and then Euro Yen long. Thanks, Dan. Good one. Okay. Thank you for your participation, guys. That's how I like it. We're here together as a team. We're looking at the market. We're trying to figure out good trades. I'm currently looking at long New Zealand versus yen, and I'll give you my reasoning real quick. Last week, we had S&P moving the outlook, the credit outlook for New Zealand from stable to positive. So we saw some good strength on the back of that. Then we have weak Aussie numbers, and that's leading to some cross flows. Both are high-yielding currencies out of the G8, so the cross flows could actually mean that money goes out of the Aussie into the New Zealand dollar. Sunday morning, we had building consent numbers. That's like building permits in the US coming in much higher. It's a leading economic indicator, 5.1 versus negative 1.9 last time. So I like the picture. I don't like Wednesday's expected numbers for New Zealand. I do need to be keenly aware of that, that could be negative on Wednesday, the numbers for the New Zealand dollar. But what I expect is that my colleagues are going to, my former colleagues are going to move the price higher into that number, and that could be enough for the trade. Yen, we're seeing a falling VIX, we're seeing treasuries down, we're seeing a risk-on environment. So that's good reasoning for shorting the yen. The risk to the trade obviously is a sentiment change from risk on to risk off, and that would see inflows into the yen. And we do have on Tuesday a New Zealand dollar bank holiday, so less liquidity, easier to manipulate the market. And on Tuesday, we also have ANZ's commodity prices. Commodities have been coming off, so that could actually be a little bit dovish if they underperform. Hence, I'm choosing a very conservative entry that I'm going to show you next. The role reversal is in gray. That would be my natural long. The POC that you can see here, hang on, I think you can't see anything. Let's see, where's my highlighter? Here. That's the role reversal right here. That's already been bought. Then here's the POC, this golden line. That's where I would normally buy. But I'm looking for a very conservative entry back down to the weekly pivot. We see a confluence of former POCs right here. So that's where I'm looking to long. Again, the pip number is there's, thank you very much, money made, gold short, oil short just worked out. Thank you, oil market. Plus 70 pips, plus 70 pips. And that's around 1.5% on my risk. So that trade I entered there. And let me show you the oil trade real quick that we did, and then we'll take a question if Tim still gives us a little bit of time. Okay, so this was the short that we did in the oil market early on. We shorted 55.66, tiny little bit early. We saw the market move 10 ticks against us, and then we just flattened it out at 54. Classic WTI trade in the London session, because in the London session, normally you trade Brent and not WTI. So it's a range-bound market, and we were having a look above, that's what we call it, a look above former resistance. We had sell limit orders stopping the advance, exhaustion, and then the market came off. Trading can be very simple. Once you know what you're doing, it can be very simple. And we do the same thing every single day, guys. Every single day. It never changes. It's just the same stuff over and over again. That's why I started an education company. Otherwise, I would go insane. It's so boring. Anyhow, any good questions? Otherwise, I'll hand it back to Tim. I thank you for your patience. I thank you guys for showing up on a Monday morning. And I hope you have a good week. Let's make some money, and I would be very happy to see you all again next Monday. Would be very great to see you. Marius, thank you for coming in. Thanks to my traders showing up every Monday. And I don't know, I guess we lost our host. Tim, you still there?
Oh, no. I'm just.
Oh, you there? You there?
I'm just studying because of what you're talking about. And yeah, Jay, first of all, thanks a lot for you showing us, what's going on the market and what are the conditions on the markets. And yeah, I have a questions, not here in these software, but some of our clients ask for your workshops. So because on your website it's just only one in this year are posted. So I don't know, maybe you have no new dates or what's the plans for this year?
Yeah, thank you for the question. We need to mention it is in German, and the next one will be end of April, and I'm putting it up on the site today or tomorrow. So the last April weekend, Saturday, Sunday, and Monday, we are gonna rock and roll again. If you want to join, it's an intense experience, but we are elevating you onto a professional level. Guys who joined 3 weeks ago are already talking about the markets. They have left retail far, far behind them. It's a profession. It's a lot of fun, and we're all fanatics. Our team is really, it's all fanatics. I mean, look at the room here, Tim. Of the traders in here, a bunch of them are traders from our team, and I can't appreciate the guys enough, and the girls. I love working with these guys. I love working with you guys over at Admiral. Thank you for the opportunity to increase the professional knowledge amongst retail traders. That is the purpose of our company, because it's ridiculous to be looking at technical analysis. The market does not trade based on technical analysis. Professionals look at rate of change of GDP growth and inflation. We have hundreds of analysts working for us in the bank at the funds, and nobody is looking at a 200-day moving average. Nobody. It's a mirage. It's a fantasy. It's a little bit complex to learn, but once you learned it, then you just have a repeatable process every day and every week that you implement, and you make money every week. In the bank, the question is not if you make money, the question is how much money do you make? That is the difference. It's about performance perfection, perfecting your own personal performance. And I can teach the knowledge. What I then encounter, Tim, in this last sentence from my side, is psychological issues. It's mostly psychological once you learn how the game is played. And we're working quite a bit on that. Thank you for your time, and have a great week, guys. Let's make some money, and I'm looking forward to seeing you again next week here. All right?
All right, Jay. Thanks a lot again here for your introduction and for your nice informations about your workshops. And yeah, for sure, thanks to your team and all our other listeners here. Is always very interesting. To work here with you on this webinar always on Monday. So yes, you always said it. And next week you are back on Monday. Tomorrow we are back from Admiral Markets with another trader. So feel free to join us. And for more information, check out our website. That's it for me for the moment, and have a good day, good trades, and see you. Bye bye.